Hello everyone and welcome to the Week in Markets. You've got myself, Chris Leyland, Director of Investment Strategy. I'm delighted to be joined by our Head of Investment, Kevin Kidney. So maybe just to set the scene a little bit so far this year. So this is the first Week in Markets I've done this year. It's actually been a really good start to the year. We've seen good returns come through from equity markets, but also from other assets such as gold overall. But it's not about this year, it's about this week. And let's focus domestically first. So UK GDP came out positive?
It did. So we had GDP for December released on Thursday. So that gave us the full quarter four. So expectations were for a modest contraction. That is, GDP would actually have declined through the final quarter of last year. Thanks to a surprising December print, the quarter grew modestly, so 0.1%. So we did see growth, and that took annual GDP growth for 2024 up to 1.5%, which is bang on the estimates of, for instance, the Office for Budget Responsibility. So a surprising and pleasing end to the year for the UK.
Excellent. And obviously growth is Labour's key priority. 0.1%. No, it's only a very marginal positive amount. Obviously for Q3, we saw basically flat growth in respect to UK GDP. Maybe a little bit of a tough time, do you think, for the UK economy?
I think the next 3 to 6 months are probably going to be the most difficult for the Chancellor for a number, and for UK in general, really, for a number of reasons. The first is that the National Insurance contribution tax rises haven't come into effect yet. That's April. The increase in the national living wage, that's also in April. So these cost pressures for British industry and businesses hasn't gone through yet, but we've already started to see in the employment data a real pullback from employers. Employment has actually fallen through November and December based off the HMRC payrolls data, which is more reliable than the labour force survey. That's actually people being deregistered from PAYE income tax. And we get more jobs data next week, and there will be another jobs print before the March budget update. So momentum in GDP was pleasing for the UK economy. It's just unsustainable if we're seeing job losses come through and tax rises ahead. So that's the messaging that's going to be difficult for Chancellor Reeves in March.
Excellent. Maybe just finally sticking with the UK, if some clients are watching right now, maybe they're a little bit nervous around the UK economy. It's important that the UK economy isn't the UK stock market, and actually we've seen pretty decent performance.
Absolutely, yep. So it's been a really great start to 2025 for global equities, and it's Europe which has been leading that. So mostly continental Europe, Germany, France, Italy have had very, very strong starts, but so too has the UK. The FTSE 100 is up pleasingly for this year, and that's being led by the energy sector and in particular by banks. UK banks doing very well, very profitable businesses, and they're returning a lot of capital to shareholders through buybacks and dividends. So I should also add that earlier in the week, another all-time high for the FTSE 100. So, and we've seen all-time highs on Thursday again for stock markets in Germany and Spain and Italy, and it looks likely that the French index, the CAC 40, will reach a new high within the next week or two. So a real strong equity story globally, but it's being led by Europe and the UK, which is very pleasing, and that's in no way a reflection of what's going on in the UK economy, of course, which is subdued growth.
Excellent. No, that's really good news there. And maybe just across the pond onto the US, I know a lot of investors really keenly watch US inflation prints. Could you just walk us through what came out?
So our biggest risk that we identified at the start of the year would be that inflation's a bit stickier. I think the markets were braced for that. That's probably a consensus view. The US GDP print, the US CPI print for January reflects that worry, which is it came in a lot stronger than expected. It was about 0.5% for the month, so inflation actually ticked up, CPI inflation. I think markets have really taken that in their stride. If we go back this time last year, markets were expecting about 6 rate cuts in the US. So when strong inflation prints came in, there was a bit of a shock in the market as interest rate expectations got dialed back. We began this year with almost no interest rate cuts expected in the US. So the market doesn't really have a lot to roll back on. It doesn't need to readjust expectations for interest rates that much. I think what this CPI print reflects is the US Federal Reserve, which controls interest rates there, doesn't really have to worry about a slowing economy. And it's highly likely that they will just remain in wait and see mode. The bar for any rate hikes is much higher than the bar for rate cuts. So inflation somewhere between 2 to 3%, or even slightly above 3% as it's gone in the last couple of quarters, won't be a worry given interest rates are above 4% in the US. So it's still an adequate policy setting for firm inflation. And of course, the stock market, it hasn't been that much troubled by this either.
Excellent, thank you, Kevin. And in some ways, when we're filming this, there's quite a lot of ongoing news flow around this. So I do want to caveat that things are changing minute by minute. But I guess Donald Trump with the presidents of Russia and Ukraine.
So if we characterise the risks on inflation as being our tail risk, that would adversely affect portfolios. The one risk we identified at the start of the year, which would benefit portfolios, would be a swift resolution in the Russia-Ukraine conflict. It was always the case that the Trump administration were going to try and force a peace across both Ukraine and Russia. This seems likely, at least a ceasefire anyway, to come. That is undoubtedly good for stock markets and for bond markets. And it's no surprise that the reaction this week has been greatest in European stock indices again. And that's why we've seen these new highs in Germany and Italy and Spain, and why France is doing so well. It's because Europe was most impacted by the trade embargoes on Russia and by the outbreak of conflict. It should benefit the most if there is a ceasefire, in the short run anyway, and perhaps Russia is allowed to trade officially again in gas and use the SWIFT payment system. So that's a dovish surprise, and it's likely to feed through into markets for the rest of the quarter.
Excellent. Thank you, Kevin. That was a really comprehensive review of everything that's happened this week. I hope you really enjoyed it at home. Please do like and subscribe to our YouTube channel. And Kevin and myself look forward to speaking to you soon. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.